Welcome everybody. We've still got a few people joining, but hopefully they're not too far away, so I might start. For those of you that don't know me, my name is Neil Billyard. I'm the National Head of Tax here at BDO. Welcome to our federal budget review. We're going to cover a number of things this time round, so not just tax, we will look at some of the broader economic consequences as well. I will introduce the speakers in a minute. Firstly, I might just give some broad overview and some observations. Firstly, I think everyone will acknowledge that this is an election budget, and that becomes quite clear when you start to look at the content and start to think through short-term comments and initiatives and longer-term initiatives. From a short-term point of view, there's a number of things in here that deal with temporary cost of living issues. There's a lot of talk about job creation, and I suppose the challenge is how quickly some of those jobs can be filled and by who. When you start to look at longer-term initiatives, I thought it was quite light on in terms of some of the ESG and sustainable type initiatives. And the other thing, as a tax person, every time we have a budget, I would love to see true tax reform, and as usual, I am disappointed, and I expect I'll be disappointed for the rest of my career, but certainly there's nothing on that front. So I suppose my observation is maybe it's not so much what's in the budget, but maybe what's not in the budget is quite interesting to me. Some broad themes, and you may not agree with all of these, but if you read our BDO summary yesterday morning, which I'm sure you all did, there's a reference to bread for the masses. Clearly, there's some money available to a lot of people, not a lot of money. I don't think they'll be eating caviar, so probably bread is the right term. From a business point of view, I think there's a lot of hurdles and issues that people would have liked to have seen addressed that haven't been addressed. Bit of a warning for those who might not be doing the right thing. Definitely Big Brother is watching. We're seeing about $650 million being given to the tax office to expand some of their enforcement task force, and a lot more interaction between state authorities, Office of State Revenues and Tax Authority, Federal Tax Office. So, you know, be warned that if you're not doing the right thing, there's going to be more and more compliance heading your way. Once again, we see a lot of money on infrastructure spending. The interesting challenge will be resourcing some of those jobs. There's a lot of stuff on regional grants and regional opportunities. What I'm hearing on that front is it's great having these projects, but some of the softer infrastructure is a bit of a challenge. So why would people want to go and live in some of these places? Yes, there's a job, but there may not be other stuff, some of the social stuff that would interest them in even living in these places. So there are interesting challenges with some of these projects and getting the right staff in the right places. Apprentice wage subsidy, that's always a positive thing, so that's a tick. Manufacturing, we saw this during COVID where some of the things we wanted manufactured were all being manufactured offshore, and it came to light that maybe we should be doing a little bit more onshore. So we are seeing some incentives aimed at bringing that back onshore, which is great to see. And as I mentioned before, not a lot of true long-term reform. Will we see it after the election? Regardless of which party wins the election, I wouldn't hold your breath. So moving on to what we're going to talk about today. We have 3 speakers other than myself. So firstly, I'll ask Ali Flint to give a big picture analysis. Ali is an economist in our Project and Infrastructure Advisory Group. So she will start off with some sort of broader economic context and some observations around what she's seeing in the budget. We'll then move on to the more specific tax stuff. So Catherine Dean will then talk. Catherine's a corporate tax partner, so she will focus on company, corporate tax incentives and tax changes. And then lastly, James Trainer, James deals with employment taxes, FBT, expats, a whole lot of other things. So maybe James can tell us a little bit about himself. But James will talk more about initiatives that directly impact employees, whether it be tax incentives for employees themselves, or whether it be some of the corporate incentives, employee share schemes that have a direct impact on employees as well. So I will hand over to Ali now, and just from a administration point of view, if you have any questions, please feel free to put them in through the chat function. What we will do as the questions come through, if they're easy to answer and add to the understanding of the presentation, we'll interrupt the speakers and get them to address them quickly. If they're a little bit harder or maybe don't add to the flow of the presentation, we'll reserve the right to hold those to the end, and there will be a little bit of time at the end to deal with some of those questions. So one way or another, we hope to be able to deal with all your questions in the next hour. I'll hand over to Ali to give us some of the big picture observations.
Thank you, Neil. The federal budget has predicted a stronger than expected economy going forward, with a smaller deficit predicted for the end of this financial year than was thought 3 months ago. And while we're seeing global volatility, particularly between the war between Russia and the Ukraine, Australia has benefited from stronger commodity prices for gas, coal, iron ore and wheat, which all adds to our revenue and strengthens our bottom line. So overall, the budget presents a good news story with a lot of spending on new policies, including one-off payments and tax cuts to benefit family and businesses. Some of the things that are notable within the planning numbers for the budget. During the pandemic, Australia's population declined for the first time since World War I. And this resulted, as we all know, in skill shortages and a tighter labour market. Now, the main driver of this is the outlook in the federal budget is a return to positive international migration by June of this year. There's also a change to the permanent migration program. So the skilled visa stream now accounts for 70% of permanent migration, which represents a shift away from the family visa stream. Now, this is expected to give a boost to the business sector, who is struggling to recruit skilled labour, but it might not be enough to alleviate the pressures that we're seeing. The budget is also predicting a low unemployment rate of 3.75% by June next year. Now, this is the lowest unemployment rate since the 1970s. It's quite an optimistic outlook, but it may also, again, have significant issues for the business sector, signifying that potentially the tighter labour market conditions may worsen. We're also seeing an increase in expected regional visa planning levels, making regional population growth likely. But there's also caution in that because we are not seeing targeted job creation within the budget program, so that might affect employment for migrants moving into these regions. Could we go to the next slide? Thank you. So our economic growth has been revised upwards. So real GDP, which is a measure of how well the economy is doing, that has been revised upwards from the mid-year economic and fiscal outlook. And that has been driven by stronger than expected labour market conditions and consumer spending. So we are expecting consumption to be supported by higher household incomes as unemployment decreases, and also some wage growth increases which are predicted in the budget. So future growth is expected to come from broad-based increases in consumption, investments and exports, as well as obviously the rising commodity prices. And we're expecting that revenue to be supported by public expenditure. Thank you, Neil.
Thanks very much, Ali, for that very comprehensive economic summary. So I'm going to cover some of the corporate highlights or matters relevant for the corporates in the federal budget. As Neil alluded to at the start, really, it is an election year budget, and it's probably notable for what's not in the budget. There's not really any large tax reforms. It's more tinkering around the edges and putting some cash in people's pockets right now. So today I'm going to cover about 8 topics. Fuel taxes, so obviously the reduction in the fuel tax excise, some of the temporary incentives that applied during COVID, which is notable in that it just wasn't mentioned in the budget, so by default they're not being extended. A new patent box expansion, an extension of the ATO's tax avoidance task force, so ramping up of some compliance activity there. Some miscellaneous amendments to the tax laws, some specific measures relevant for small business, so it's defined as less than 50 million turnover for the purposes of those measures, some other tax compliance changes, and then finally I'm going to cover just some of the incentives available if you're an employer of Australian apprentices, and also just some of the big picture on some of the infrastructure spending. So there's a $7.1 billion cash splash, mostly across the regions. So firstly, on the fuel taxes, well, the headline is it's a huge saving. This measure, which is an immediate 6-month temporary reduction in the fuel tax excise levy, applicable to petrol, diesel and other fuels, excluding aviation, will be apply from the 30th of March 22 up to 28th September 22. So really part of a suite of measures aimed at addressing the cost of living pressures, particularly with the cost of fuel at the moment. It's really aiming to provide a cash boost indirectly by reducing the cost of transport, which is a large cost for many living in Australia, particularly with distances and the cost of transporting goods. So what is it? It's a reduction in excise from 44.2 cents a litre imposed by the federal government at the moment, or previously, down to 22.1 cents a litre. It's actually a reduction of 24.31 cents after you take into account the GST. So obviously for any reduction in excise will also reduce businesses' fuel tax credit entitlements. So those businesses in the mining, ag sectors in particular may not see a big difference if they're claiming through the fuel tax rebate system already. As a practical matter, we just advise that businesses should really check any pass-through clauses and pricing mechanisms in any commercial contracts, which may contain clauses dealing with fuel costs or fuel tax credits. So the measure is expected to cost approximately $3 billion. It's one of the key measures in the budget. Next on the sunsets on the temporary COVID incentives. So announced with some fanfare in the previous budget. The 2 measures broadly are the loss carryback and temporary full expensing measures. So they just weren't mentioned in the budget. So by default, the sunset date of these measures, which is to 30 June 2023, will not be extended. So what does that mean? If you are eligible, you should really consider your CapEx and acquisitions program to consider eligibility and whether you can utilise these measures up to the expiry date, which appears to be a hard close at this stage. So in terms of that loss carryback measure, that applied to companies with aggregated turnover of less than 5 billion. You could elect to carry back losses that were incurred in your 2020 to 22 income years back to the 29 income year onwards. So there were some rules around it, so you couldn't carry back losses more than your earlier tax profits, and you couldn't generate a franking deficit. The second measure is, of course, the temporary full expensing. And that measure is again applicable to companies with aggregated turnover of less than 5 billion. There is also an alternative aggregated turnover test where companies had turnover exceeding that 5 billion threshold, but you had your Australian income was less than 5 billion and the company had invested in depreciating assets for the 2017, 18 and 19 years of an amount more than 100 million. So again, this measures sunset clause is 30 June 2023, not extended. So really consider your eligibility for this measure. It was one of the centerpieces of the previous budget. I think it was a cost of about $27 billion, so it was a large cost for the federal government. Interestingly, the instant asset write-off, which applies to companies with an aggregated turnover of less than 500 million, that does differ from the temporary full expensing. There is no announcement yet on whether those incentives will be reintroduced after the end of temporary full expensing. So moving on to what is probably the only major piece of reform in this year's federal budget, which is the expansion of the so-called patent box regime. The government is broadly going to expand this tax regime from only applying to the medical and biotech sectors to also include the agricultural sector and also low emissions technology innovations. So for medical and biotechnology sectors, I think the legislation is currently before Parliament and should apply from 1 July 22. I'll just go into the expansion on the next slide, but there is also an expanded application to agriculture and low emissions technology, and those changes will apply from 1 July 2023. So what is the patent box regime? It basically gives you a concessional tax rate of 17%. So if you're a large corporate, that's a decrease of around 13% from your standard corporate tax rate, and about 8% for your small and medium enterprises with the 25% rate. So that rate applies to ordinary income that's derived from exploiting the Australian-owned and developed patents. So it's trying to encourage innovation and R&D in Australia. Interestingly, so the medical and biotechnology innovations which applied from last year have been extended to those innovations that were granted or issued after 11 May 2021. So that's from last year's federal budget to now include standard patents granted by IP Australia, utility patents granted by the US Patents and Trademarks Office, and also European patents granted under the European Patent Convention. The innovations related to agri relate to the commercialisation of registered agricultural and veterinary chemical products or plant breeders' rights granted or issued after the 29th of March this year. And again, the low emissions technologies, the start date is for those patents granted or issued after 29th of March, which have the potential to lower emissions. These measures are still under industry expert consultation, so I'll just caveat that. So the next measure is the extension of the ATO Tax Avoidance Task Force, and as Neil mentioned at the beginning, the ATO is being funded with an additional $650 million, with an expectation they'll raise approximately $2.1 billion from taxpayers. Now, there's a focus on multinationals, large corporates, as well as high net worth individuals. So this task force, which has been in place for the last couple of years, has already raised $23 billion from taxpayers. So it's really one to watch in terms of your compliance obligations. Just some of the miscellaneous amendments that are coming through the budget. Interestingly, there's a measure on tax records education, which is a proposed new law offering the tax office an alternative to issuing administrative penalties where taxpayers fail to comply with record-keeping obligations for tax purposes. So the Commissioner will have a new power under this law to issue a tax records education direction to complete an approved record-keeping course in lieu of a penalty. Look, I think it's a welcome measure. Certainly, often taxpayers inadvertently, don't keep the appropriate record, so it's good to give an alternative here. In terms of the intangible asset depreciation measures, so this is a small legislative amendment allowing taxpayers to self-assess the effective life of certain intangible depreciating assets rather than using the statutory effective life, which is currently the case. So I think it's a good measure. It provides a bit of flexibility. Taxpayers can also recalculate the effective life where the circumstances relating to the use of the asset have changed, and you are required to recalculate if the cost increases by 10% or more in a later year. So what does that apply to? Examples of standard patents, innovation patents, designs, copyrights, and other licenses and in-house software. It applies to assets that you start to hold on or after 1 July 23. So for small business, the budget did contain a couple of measures, mainly aimed at skills and training and digitalisation. So these measures apply just to those businesses with aggregated annual turnover of below 50 million. That aggregated turnover test is always a tricky one, as you might think, oh, well, we're fairly small in Australia, but it does involve tracing up through the chain of ownership. So it can be quite a complex test to apply. So just be aware that you should seek advice before confirming your eligibility. So if you do apply, sorry, I might just go back a slide. Yeah, it does give you an additional top-up 20% deduction for expenditure on external training courses provided by registered training entities. It's got to be external to the business, so internal courses are not covered by these measures. The top-up deduction is allowed from budget night up to 30 June 2024. So, and in terms of small business, again, there's this technology investment boost, very similar to the training measure. So again, applies to those with aggregated turnover of below 50 million on an aggregated annualised basis. And it applies an additional 20% deduction for expenditure to support the digital adoption by small business, including depreciating assets. So examples might be where businesses install cyber security systems or cloud-based services. There is a cap annually of 100,000, and that will apply for the next year, so from budget night up to 30 June 2023, about 15 months. For completeness, there's a couple of tax compliance changes to note here. So the first is the modernisation of the PAYG instalment systems. So this will enable companies to choose to have PAYG instalments calculated based on their current financial performance with tax adjustments, rather than being based on your prior lodged tax returns. So the aim here is to support business cash flow and to have instalments reflect the current financial performance. The expected start date here is 1 January 2024 for this measure. There's also what has been branded as smarter reporting of the taxable payments reporting system data. So where you're captured by these reports, normally it's an annual compliance obligation in addition to your BAS and income tax returns. This change will allow reporting on the same lodgement cycle as activity statements, so commencing from 1 January next year, 2024. If you are, I mean, the aim here really is to reduce red tape as well. There's also a measure providing for the digitalisation of trust and beneficiary income reporting and processing for trust tax returns with an expected start date of 1 July 2024. And going back to the point Neil raised earlier in terms of interactions between the ATO and state revenue increasing, there's about $6.6 million in funding allocated in the budget for a new IT system to be installed between the ATO and state revenue to allow a sharing of single touch payroll data. So that would be your employee payroll reporting. The last points I'm going to cover relate to Australian apprenticeships and also the infrastructure funding and spending announced in the budget. So there's quite extensive reforms relating to Australian apprenticeships incentives that may be relevant for a number of businesses. Some of these incentives support employers and some of them are paid directly to apprentices that are in Australia. Broadly, the budget contains over $2 billion in funding for the next 5 years. There is a focus on priority occupations. I did have a look at the list. There's about 77 of these priority occupations for apprenticeships. So we can provide more detail if people are interested. I've got on the next slide a summary of some of the incentives available. They are quite, there's quite a long list of them. But, yeah, the main one is the wage subsidy scheme for employers of Australian apprenticeships in those so-called priority occupations. That provides a subsidy for employers of up to 10% of the wages for the for first and second year apprenticeships, for up to $1,500 per quarter, and 5% of wages for the third year apprenticeships, up to $750 per quarter. There are currently wage subsidy schemes providing an incentive up to $28,000 per year, about $7,000 per quarter. So these incentives are slightly less generous than the previous announcement. These incentives will apply from 1 July 22 up until 30 June 2024. We will share the slides after this call, so if you are interested in those incentives, we've got a list available for you. So finally, the government announced in the federal budget $7.1 billion in infrastructure spending, really focused on the regional development plan. So the aim is to develop key regional areas and economies, but particularly in investments in infrastructure, low emissions technology and energy production. So there is a focus on new energy such as hydrogen projects. Some of the key investments, that $7.1 billion spending, $2.6 billion for Northern Territory projects, $1.7 billion projects in North and Central Queensland, $1.5 billion going to the Pilbara region in WA, $750 million for projects in the Hunter region in New South Wales. For example, of that $750 million in the Hunter, I think about $100 million is going to one of the ports for investment in to do some FID on a hydrogen project in the Hunter in the Port of Newcastle. So the remaining funds will be invested in other regional projects, broadly across regional Northern Territory, Queensland and Western Australia. There's some specific funding, particularly on delivering safety upgrades to level crossings in regional and rural areas, and also some funding for MRI services in those rural and remote areas. And over to James.
Thanks very much, Catherine. Well, for individuals, the budget was all about the low and middle income tax offset. So there's been a lot of discussion and media around this particular offset in the lead up to budget night. And the question everyone had was, would this be a tax cut? Would it take away this benefit that individuals had achieved over the last couple of years? And so in an ingenious way, the government took the air out of the story. So it doesn't continue on to next year, but what they did is actually increase it for this year. So the maximum offset increases by $420 from $1,080 up to $1,500. And it is paid as returns are lodged after the 1st of July 2022. It's important to remember this is a non-refundable tax offset. So if someone actually doesn't have an income tax liability, they actually don't get anything. Also, at higher income levels, the offset starts to phase out as well. So above about $90,000, it starts to phase out, and above $126,000 of taxable income, then the offset phases out completely. And as I mentioned, this is the last year for the offset. Around employee share schemes, there was some relaxation announced in the budget for employers who are offering employees an opportunity to invest in their company. I got a little bit excited when I saw this in the budget papers that this might extend beyond just regulatory relief. But when the legislation came out yesterday, it confirmed that it is actually only regulatory disclosure relief. So employers who have to give disclosure documents to their investors, including employees, and that can be a bit onerous and make it difficult for employers to offer share schemes to their staff. And so what this change does, it actually relaxes some of those obligations for employers when employees are able to invest up to certain amounts. So it's the $30,000 per year, which can be accrued over 5 years, so up to $150,000 worth of investment in the company, plus if a certain percentage of dividends and cash bonuses are being used to acquire an interest in their employer. So it makes it a little bit easier for those companies to offer shares and options to their staff. There's also a relaxation of the disclosure requirements for non-employees, so for independent contractors who might be engaged by an employee, by a company, and who's being invited to participate in the employee share scheme that's available. Another change for employees is around COVID-19 tests. Now, this measure had been announced prior to the budget, and it was just restated in the budget. And we've actually seen the legislation come through, which gives us a little bit more detail around what's happening. So the key things there is that there will be a tax deduction that's available to the individual if they have to incur expenditure to get a COVID-19 test. A couple of restrictions on it. It only relates to COVID-19, so it's not a test for anything broader, so it's very limited to what's happening today. Hopefully we don't see another pandemic down the track, but if that is the case, then that might need to be covered by separate legislation. And it also only covers prescribed types of tests, so a PCR test or rapid antigen test. So it's quite prescriptive in terms of the types of tests that are available for this tax deduction for employees. The other thing is that it needs to be taken in order to attend a place of work. So it can't be, you don't get a deduction for taking a test because you want to go travel interstate or overseas. It needs to be to attend a place of work. And again, even though it's not big numbers, the legislation or the explanatory memorandum goes quite specifically to someone who takes a test that's got two, or buys a test that contains two separate tests, one to be taken to attend a place of work, one to be taken to travel overseas. They're only entitled to a deduction for 50% of the cost. So it's quite narrow. That deduction should be available from the 1st of July 2021. So for it's going back over a couple of years. The corresponding issue for employers is that if they reimburse or provide those to their employees, the FBT, otherwise deductible exemption, can apply, so that no FBT will be incurred by the employer. Unfortunately, what this means is that the employer will need to get declarations for that because you need that for otherwise deductible to work. So unfortunately, a little bit of administrative work for the employer, but nevertheless, the deduction the otherwise deductible rule should mean that there's no FBT, and that will apply back to the start of the FBT year that's finishing just today. Looking on to expatriates, we'll probably see an increase in the number of expatriates coming to our shores. And this is going to be really important because, as we know, there is certainly a shortfall in labour, which is going to make it difficult for all of these infrastructure projects to find their way forward, and also for a lot of other businesses to grow if there is particularly no labour that's there to help them. So what we're seeing here is a change in the visa rules that will help support the growth of the Australian labour market. As was mentioned by Ali up front, we're seeing a redistribution of 10,000 partner visa places to skilled visas. So a real focus on visas to allow people to come into the country and support the labour workforce. There's a refund of student and working holiday maker visa application fees. This applies for a short period up until March or April, depending on the type of visa. And this is to encourage people to come to Australia sooner. There's also an increase in country caps for working holiday makers by 30%. Again, all designed and encouraging more people to come into the country. And finally, there's some of the restrictions, the work restrictions for student and working holiday maker visas will be relaxed to allow more of these people who might already be in the country to actually work. Just getting our slides to catch up. Thank you. And finally, a point that was touched on by Catherine before with single touch payroll data, with the sharing of information between the ATL and the state revenue authorities. Look, this is welcome. It's certainly going down the right path. But the second point there is what I really want to call out is that the states also need to commit to investment, and it would be really helpful for anyone who practices in this space if the states got together and decided to share a little bit more information so that you don't need to potentially submit 7 different payroll tax returns across each of the states and territories where you're operating nationally. So obviously the federal government can't do a lot in that space, but we'd certainly like to see a little bit more in action from the states in that regard. Fairly short and sweet around the employers and individuals, and so I'll hand back to Neil.
Thank you, James. So hopefully you found that informative, and we do have a number of questions, so we will endeavour to address as many of those as possible. A couple of questions come through around compliance costs. I think there was one specifically on the 120% deduction for training costs, and trying to work out if you're above or below 50 million and how that works, and the cost of working it out might be worth more than the deduction. Typical of these things, government doesn't always think about the cost of compliance. The other one, probably it's my question, it's not a formal question that came in, but as I was listening to James referring to the FBT year that finishes today, or indeed the income tax year that's going to finish in 3 months' time, I wonder how many people are out there thinking, oh, that rat that I took 8 or 9 months ago, I bought a pack of 5, how many did I use to go to work and how many did I use for other purposes, and indeed do I have a receipt? So compliance, not always front of mind for government, unfortunately. Some of the bigger picture questions, there was a question specifically about a company looking to list on the ASX. My comment on that would be there are some incentives and benefits here that will have a cash flow impact and will help a company if you fit within those rules, but they're not specifically aimed at ASX listing or proposed listing. So I'm not aware of anything that is specifically aimed at that question, unfortunately. One of the other ones I might touch on, I sort of opened with my gripe about true tax reform and never seeing it. There's a question around GST and what would it take to get the GST to 10% to 15%. I think that's a great idea, and absolutely we should do it. Unfortunately, when John Howard brought in the GST and the politics he had to go through to get it through, requires, I think it's a majority of voters in a majority of states to get it through, and probably needs the input of the relevant state governments and premiers to support it, I would have thought. And during COVID, we've sort of seen that federal and state tend not to want to work together very well. So I'm not sure that either political party will have the desire to tackle that one, even though it's a good idea. A couple of other questions there.
I can pick up a couple if you want.
James,
Neil,
you want to jump in and grab a couple?
So there was a question there around the other types of items that employees might get or employers might provide, sanitizers, masks, that sort of things. The otherwise deductible rule can potentially apply to those if they are required in work. The problem with the COVID-19 tests was that it was required to get you to work, and that was the issue around it not being otherwise deductible prior to this legislation. But things like sanitizers and masks, which you would use once you're at work, should fall into the otherwise deductible category. There should be a deduction available there, and also a corresponding exemption from FBT.
What about the mask you have to wear on the train?
Keep wearing it in the office, and then I think you'll be fine. There's also a question around the Lamington and about whether it can generate a tax refund. The answer is no. It's a non-refundable offset, so it can only push your tax liability down to nil and not below that. And although it wasn't a specific question that popped up, there's one thing that I just wanted to mention, which I didn't, given we have a little bit of time. Car parking, and I know anyone who's heard me speak over the years will know how much I love FBT on car parking, and the ruling that came out during the year that expanded the application of car parking to what might not be considered commercial car spots, but hospitals and the like. The government just announced in the last couple of days that they're going to revisit that and will potentially take a step back from the recent ruling around car parking. So we might see a little bit of a reduction in FBT on car parking. So apologies, not a question that was on there, but I think something that's useful for people to be aware of.
No, I might just jump in. There was a question at the beginning. It was mentioned the ATO received additional funding. Have other regulators received additional funding as well? So ASIC and APRA. All those bodies are funded through the federal government. The ATO task force was specifically addressed in the budget because it was a large sum just allocated to this particular task force activity, which has the aim of raising revenue, which is also costed into the budget. So the aim is to raise $2.1 billion over the next couple of years with this measure.
Couple of other questions around the technology investment. In particular, two questions asking whether we get a 120% deduction for zero subscriptions. The announcement itself does refer to cloud accounting, so I assume that's where that question's coming from. We don't have a lot of detail on it. From a policy point of view, I wouldn't have thought they're trying to cover that sort of thing. They're looking at, encouraging new expenditure. But until we see the detail of the legislation, I think it's a fair question, and maybe it will be caught. So I think we need to see a little bit more on that, and it'll be interesting to see if the government does try and carve that out, because I'm sure that will be a pretty significant deduction across the whole economy, given how popular those sorts of subscriptions are.
There's also a question, would the budget impact real estate investors, first home buyers and real estate businesses? So I think measures such as the first home builder program, that was about $2 billion government subsidy in the previous budget, obviously hasn't been extended. There are some general measures, but not specifically aimed at real estate investors.
Yeah. I mean, there was a little bit of it. There's an extension to some of the first homeowner guarantee schemes, which have been around for a little bit, a little while. So they've been extended out a couple of years, which might see, a few more home buyers in the market. But it's relatively small amounts that are involved there.
I think that's most of the questions. Certainly, if you've got any more questions, please feed them through, either through this channel or through your BDO contact. Hopefully that session has been informative. There's some interesting announcements in there, and as I said at the start, I think the big issue is probably not what's not been said. Mr. Albanese gets his opportunity tonight to respond, so it'll be interesting to see how many new initiatives we get and how much detail he wants to provide. BDO will be having a look at that, so we will produce something on that tomorrow. I suppose the detail of our production will depend on the detail of the announcement, so we do look forward to that. So once again, if I could thank everybody for their time. It's great that you're able to join this webinar. Hopefully we'll see a few more of you in person in the coming months. But as I said, if you've got any questions, please reach out to us and we're happy to deal with those questions collectively or on a one-on-one basis as appropriate. Thank you.